Hello, and welcome to What Would Peter Lynch Do? This is our 37th deep dive exploring the wisdom of legendary investor Peter Lynch.
Great to be here.
Today, we're tackling a really interesting question from a listener. They asked, amidst the buzz surrounding Jeff Bezos' extravagant wedding, I saw on the news that he will sell a large amount of stocks. How will the buying and selling of stocks by owners, CEOs, and other corporate executives affect the stock price?
Yeah, that's a fantastic question. And it gets right into something that often confuses investors, especially newer ones, insider trading.
Exactly. So today, we're going to try and pull back the curtain on this. We'll use that Jeff Bezos news as our jumping off point.
Right. We'll look at what these insider moves really mean for stock prices and maybe more importantly, how you as an investor can actually interpret them without getting, swept up in the headlines.
We'll explain who these insiders really are, why their trades matter so much, the rules, basically everything you need to understand it.
Good, let's dive in.
Okay, so first things first. When we say insiders, who exactly are we talking about? It's not just like every employee at Amazon, right?
No, definitely not. That's a really key distinction. The term insider is actually very specific. It's legally defined by the SEC, the U.S. Securities and Exchange Commission. They're the main market regulator.
Okay, great.
And an insider isn't just on the payroll. They are people who have access to what's called inside information. That means significant info that isn't public yet, stuff you and I wouldn't know just reading the news.
Gotcha. So who usually fits that description, like specific roles?
Yeah, typically you're looking at key executives, people making the big decisions, your CEO, your CFO, also directors, so the board members who oversee management.
Right.
And importantly, 10% or greater shareholders. So any person or institution that owns a really significant chunk, 10% or more of the company's stock, these are the folks whose trades we really watch.
Okay, so let's talk about buying first. When these insiders buy stock in their own company, that's generally a good sign, isn't it? Like a
Yeah.
strong positive signal.
Oh, absolutely. It's widely seen as a very strong positive signal. I mean, think about it. The people who know the company best are literally putting their own money into it.
Yeah, betting on themselves.
Exactly. It shows real confidence in the future that they expect growth and, well, that they think the stock price is going up.
I heard a good analogy for this. Imagine you run a robot company with a guaranteed hit product coming out. You'd buy your own stock.
Yeah.
It just seems logical.
It is. You'd want a piece of that success. And
Yeah.
we saw a great real-world example back in 2022. Netflix stock took a huge hit, right?
Oh, yeah, I remember that.
Well, co-CEO Reed Hastings stepped in and bought about $20 million worth of Netflix stock. That sent a really powerful message, basically. The stock has dropped excessively, and our company's future is still bright.
Wow, $20 million. That's a statement. So, okay, beyond just confidence, why is insider buying considered such a powerful signal? What's the core reason?
Well, first, it's probably the most definitive skin in the game. Talk is cheap, right? But when they use their own cash, that's a real financial bet.
Like the restaurant owner, eating their own food every day, you trust it more.
Precisely. Second, there's information asymmetry. Insiders just know things we don't. Maybe product development is going smoother than expected. Maybe they're close to landing a huge contract. Maybe they know a competitor is struggling or just, the internal morale is really high. Stuff that's not in the quarterly reports.
That makes sense. They have the inside track.
They do. And third, it can be a contrarian signal that overcomes market fear. This is especially powerful when everyone else is panicking.
Right.
If insiders are buying when the market is pessimistic, it's like they're saying the market's fear is exaggerated and our company's intrinsic value is much higher. Think about the COVID crash in early 2020. Airline stocks were getting hammered.
Understandably.
Yeah, but Delta Airline CEO was actually buying large amounts of stock then. It signaled real confidence in the long-term recovery, even amidst that huge uncertainty.
Okay, that's compelling.
Yeah.
But it sounds like we shouldn't just blindly follow any insider buy. Are there nuances, things we should look for?
Oh, definitely. You need to dig a bit deeper. First, consider who bought. A buy from the CEO or CFO usually carries more weight than, say, a director or maybe a lower-level exec. They're steering the ship.
Right.
Second, how much was bought? Was it a significant amount relative to their salary or their existing holdings? A tiny purchase might just be symbolic. A multi-million-dollar buy. That's serious conviction.
Size matters.
It does. And third, maybe most importantly, was it an open market buy? This is key. Did they go out and buy shares on the stock exchange with their own cash?
As opposed to.
As opposed to just exercising stock options they were already granted. Those options are part of their compensation. An open market buy is a deliberate investment decision using their personal funds. That's the signal you really want to see. Okay, now let's flip it. Insider selling. This is where it gets, well, trickier. It's really difficult to conclude that it's always a bad signal.
Yeah, I can see that. My first thought is, uh-oh, they know something bad is about to happen. But you're saying, maybe not.
Sometimes, yes, it absolutely can be a red flag. An insider might sell because they have negative inside information. Maybe they know growth is slowing or a bad earnings report is coming.
Like the captain selling his lifeboats example.
Exactly. What would you think if a ship's captain suddenly started selling his own lifeboats?
It makes you nervous, right? That kind of unexpected large selling can definitely be a warning.
But then there's the Jeff Bezos situation, selling potentially for a wedding or other reasons.
Perfect example of when selling can be a neutral signal. Insiders often sell for purely personal financial needs.
Yeah.
Big life events like a wedding, yes, but also maybe funding a new business, making large charitable donations, or even just paying taxes, which can be substantial when dealing with stock compensation.
Right, taxes.
Or just diversifying.
That's another big one, asset diversification. Maybe, 90% of their net worth is tied up in this one company stock. It's prudent financial planning to spread that risk out a bit.
So the why really matters here. A single exec selling a small amount might mean nothing. But what if several sell at once?
Now you've hit the key point. A small, isolated sale. Probably not worth worrying about. But if multiple insiders, maybe the CEO, CFO, CTO, all start selling large amounts simultaneously or regularly, that's definitely a pattern you want to pay attention to. That kind of cluster selling is much more likely to signal a shared negative outlook.
Okay, so with insiders having access to all this potentially price-moving information, how do we stop them from just, trading unfairly? What are the rules?
Yeah, that's crucial. There are strict regulations specifically designed to prevent that information asymmetry from giving insiders an unfair edge. In the U.S., it's the SEC, the Securities and Exchange Commission, that oversees this.
And they require insiders to report their trades, right? There's a specific form, Form 4.
Exactly. Form 4, it's the mandatory report. Insiders must file this with the SEC within 2 business days after they buy or sell their company's stock.
2 business days. That's pretty fast.
It is. And the form details everything. Who traded, when, how much, and at what price. The critical part is this public disclosure. The Form 4 info is put on the SEC's EDGR database, available for anyone to see.
So it promotes transparency.
Precisely. It helps level the playing field. Like the analogy goes, it would be unfair if only one team in a sports game knew special rules, right? Form 4 helps ensure everyone is operating under the same rules, or at least sees the trades quickly.
Okay, that makes sense. But then there's this other thing I've heard about Rule 10b-5-1 plans. Trading by the script. What's that all about? It sounds like a way around the rules.
Yeah, it can sound like that, but it's actually a legitimate system designed to help insiders. A Rule 10b-5-1 trader plan lets insiders pre-schedule future trades. It's often called a safe harbor provision, or maybe a shield of innocence.
A shield. So it helps them manage their own finances without being accused of illegal trading later. Like if they need to sell stock for college tuition, they can set it up in advance.
You got it. That's the dilemma it solves. Insiders are always potentially exposed to non-public info, but they still have normal financial lives. This rule lets them set up a trading plan before they come into possession of any material non-public information.
So the timing is critical.
Absolutely. The plan must be created in a clean state when they don't have that sensitive inside info. Think of it like an autonomous vehicle. You set the destination, the trade details when the weather is clear, meaning no inside info. The plan then executes automatically later, even if the fog rolls in and you later become aware of something.
That's a great way to put it. So what are the main requirements for setting up one of these plans?
Well, first, as we said, it must be established in an information vacuum. No material non-public info at the time of setup. Second, it needs specific conditions, clear instructions on the quantity, price, dates, or maybe a formula for the trades. Can't be vague.
Okay.
Third, there's a mandatory cooling off period, a waiting time between adopting the plan and the very first trade. For officers and directors, that's at least 90 days now after recent rule changes.
90 days. Okay.
And finally, it must follow the principle of good faith. It can't just be a trick or a scheme to get around the insider trading rules. It has to be a genuine plan.
And circling back, The case of Jeff Bezos is a perfect example. His huge sales weren't just decided last week.
Exactly right. He had established this very Rule 10b5-1 trading plan way back on November 8th, 2023. The sales then started in February 2024 after that cooling off period.
So it's pre-planned months ago.
Correct. And each time a sale happens under the plan, he still files a Form 4. The Form 4 will state something like, this much was sold according to the pre-arranged plan. It's basically him executing a procedure according to a script written months in advance.
Okay, that clarifies things a lot. But just to be sure, Form 4 and Rule 10b5-1,
Yeah.
they aren't alternatives, right? You don't pick one.
No, not at all. They serve totally different functions. Form 4 is about post-trade reporting. It's a mandatory obligation. Any insider trade, file a Form 4, period.
Got it.
The Rule 10b5-1 plan is about pre-planning. It's an optional shield, a strategy an insider can choose to use for protection. Therefore, even if you trade according to a 10b5-1 plan, you must report the actual trade via Form 4 once it occurs. One reports, the other pre-plans.
This is super helpful. But, okay, stepping away from huge names like Bezos,
Yeah.
how should we, the average investors, interpret insider selling when it's, less high profile? Peter Lynch had thoughts on this, right?
He did, and his famous quote really sums up the asymmetry. Insiders might sell their shares for any number of reasons, but they buy them for only one. Selling is just inherently more ambiguous.
So the key is context.
Exactly. For the everyday investor, you need to read the pattern and context. Don't overreact to one single sale.
Okay, so what patterns should we look for? What's the context?
Well, first ask, is there cluster selling? Are multiple insiders, CEO, CFO, maybe key division heads all selling around the same time? That's a much stronger potential warning sign than one person selling. It suggests they might share a less than rosy outlook.
Makes sense. What else?
Look at how much did they sell relative to their holdings. The volume or size matters. Is an exec selling 5% of their shares or 50%? Selling a large chunk is obviously a stronger negative signal. You can find this info on the Form 4.
Right, the percentage is key. And does that Rule 10b5-1 plan come into play here too?
Big time. Ask, was it a pre-planned sale? If the Form 4 indicates the sale was under a Rule 10b5-1 plan, you don't need to worry too much about it being a signal of doom. It was likely scheduled ages ago for diversification or cash needs. Many financial data providers flag these 10b5-1 sales.
Good to know. Anything else?
Yeah, one more thing. Compare it with buying. Are some insiders selling while others are actually buying? If you see simultaneous buying, especially open market buying, it can definitely temper or even negate the selling signal.
Okay, so let me try to summarize the practical advice. Ignore one or two sales. Don't sweat the small stuff.
Right.
Consider it a warning sign if many people sell at the same time. That's cluster selling. It could be a serious signal if they sell most of their holdings. Pay attention to the percentage.
Crucial point.
Don't give much weight to pre-planned automatic sales. 10b5-1. Check if it's under a plan.
Usually less concerning.
And above all, consider insider buying signals to be much more important. Buying is clearer.
That's a really solid framework for navigating insider sales. It cuts through a lot of the noise.
Okay, let's talk about the impact. Even if a company is doing great, can massive selling, like the Bezos situation, still push the stock price down, at least temporarily?
Oh, absolutely. Even with fantastic prospects, massive insider selling will likely make the stock price struggle in the short term. There are forces at play beyond just the company's performance.
What are those forces? Is it just basic supply and demand kicking in?
That's a huge part of it. You get a straightforward supply shock. When a massive block of shares hits the market suddenly and there isn't a corresponding surge in buyers, simple economics says the price has to adjust downwards. Massive selling by a top figure is like this.
Like flooding the market with apples, even if they're great apples.
Exactly. The quality hasn't changed, but the sudden abundance lowers the price. But it's not just supply.
What else?
There's a big psychological impact. When investors see that the smartest person is selling, or at least perceived smartest person in the room, it creates nervousness. People wonder, what do they know that I don't? That doubt dampens enthusiasm and weakens buying pressure.
Understandable. And you mentioned overhang.
Yes, market overhang. This is the pressure that comes from the possibility of more large sales coming down the pike. If investors know a major insider started selling under a plan and there's still a lot of stock left to sell, they might hesitate to buy aggressively, anticipating that future supply will keep a lid on the price. It suppresses the stock's rise.
Okay, so faced with this kind of massive selling pressure, how should an investor respond? Panic is probably not the answer. We need that cool-headed analytical framework.
Absolutely critical. Don't react emotionally. First step. Analyze why they are selling. What type of selling is it? Is it planned and transparent selling, Bezos type? A pre-announced 10b5-1 plan for diversification or other stated goals? If so, you can likely view it as a predictable supply shock, not necessarily a comment on the company's health.
Okay. What about other scenarios, like Musk selling Tesla?
That fits into selling for a specific purpose, Musk type. He sold Tesla shares specifically to fund the Twitter X acquisition. Again, the reason wasn't necessarily pessimism about Tesla's future, but rather the need for capital for a different major objective. You have to evaluate that specific context.
Right. But what's the really worrying scenario?
The most dangerous signal is if multiple top executives start selling stocks simultaneously without any special reason or prior plan. That's unexplained, coordinated selling by the people who know the most. That warrants serious caution.
Okay, so understanding the why is step one. What's next? How does my time frame matter?
Hugely. You need to clarify your investment horizon. Are you a short-term trader? If so, a large overhang is the worst enemy. The constant selling pressure will likely cap gains. It might be wise to wait until the selling wave passes or is mostly absorbed.
But for long-term folks,
For a long-term investor, this kind of situation can actually be a golden buying opportunity. Why? Because the company's intrinsic value, fundamentals, has not changed, hopefully, but the stock price is experiencing a temporary discount due to these external supply factors.
wow, the chance to buy a good company cheaper. So if I'm a long-term investor and see this as an opportunity, what's the action plan?
Two key things. Recheck fundamentals and respond with dollar cost averaging. First, do that core recheck. Use the price dip as a prompt to meticulously re-examine the company's competitiveness, growth, margins, future strategy. Really ask yourself, do I still believe in this company's long-term future?
Okay, reaffirm the thesis.
Exactly. If the answer is still yes, then consider dollar cost averaging. Since you don't know exactly how long the selling pressure will last or how low the price might go, invest steadily at regular intervals as the price falls. Buy a bit now, a good next month, etc. This strategy lowers your average purchase cost over time and helps manage volatility.
So in these situations, the big choice is, an investor must choose whether to be swept away by the short-term wave of supply or to drop anchor in the long-term value of the company. Analyze, reaffirm, and you might turn panic into opportunity. This naturally leads to thinking about how the great investors viewed this. Let's start with the man himself, Peter Lynch. How did he see insider trading?
Peter Lynch was pretty clear on this. He saw insider buying as the clearest and most useful positive signal. His core thinking was beautifully simple. They buy for only one reason. They think the price will rise.
Right, the asymmetry we talked about. Selling can mean anything. Buying usually means one thing.
Exactly. He wasn't just looking at any buy, though. His guidelines included looking for clusters of buying, multiple insiders buying around the same time. That showed shared conviction. He also emphasized real money, those open market purchases we discussed, not just option exercises.
And it wasn't a blind buy signal for him, was it?
No, crucially, he saw it as a starting point for your own research. A strong clue, but you still had to do your homework on the company. His quote sums it up perfectly. Insider buying is one of the clearest clues you can get that you might be onto a winner.
Okay, what about Warren Buffett? How did his view differ or align?
Buffett's perspective is rooted in ownership and alignment of interests with shareholders. His big question, as always, does management think and act like owners? So he focuses less on specific trades and more on high insider ownership overall.
So if execs own a lot of stock already, that's the main thing for him.
That's a huge part of it. For Buffett, insider buying is then seen as positive evidence, confirming that owner's mentality. It shows they truly believe in the long-term value they're building. He also famously considers share buybacks when the company buys its own stock as a form of corporate-level insider buying.
Interesting angle.
Yeah, it signals management thinks their own stock is the best use of capital. His classic line is, "We like to see a management that has a lot of skin in the game. We want them to be in the same boat with us."
And Benjamin Graham, the father of value investing, very numbers-driven. Where did insider trading fit for him?
Graham's philosophy was, don't rely on what you can't measure. He was all about tangible, quantitative analysis. So insider trading was definitely not a primary investment criterion for him. It wasn't a number he could easily plug into a formula.
But did he ignore it completely?
Not entirely. He viewed it as a supplementary indicator to confirm the margin of safety. If his strict quantitative analysis already showed a stock had a sufficient margin of safety, meaning it was significantly undervalued based on the numbers, then seeing insiders buying could be a powerful supplementary indicator. It offered some qualitative reassurance that maybe his numbers weren't missing some hidden problem.
So a confidence booster if the numbers already look good. How about more modern investors? Do they see it differently?
They tend to integrate it into their own specific frameworks. Howard Marks, for instance, known for second-level thinking, is naturally wary of simple signals. He might use insider buying as a psychological indicator, especially helpful when market sentiment is very negative.
Okay.
Someone like Stanley Druckenmiller, a global macro guy focused on big bets, might see significant insider buying as evidence of strong conviction by management, potentially a signal to increase bet size on his own position if it aligns with his macro view.
And maybe someone like Kathy Wood,
Yeah.
focused on innovation.
Right. For someone like Kathy Wood, focused on disruptive innovation, insider buying could help confirm that management truly believes in the company's vision of disruptive innovation. In highly volatile, innovative sectors, seeing management buy amidst the ups and downs can be a sign of long-term faith.
So it seems the consensus is that insider trading data is a really valuable tool, but it needs to be used within your own strategy and analysis. It's not a standalone answer.
Exactly. It's a piece of the puzzle, not the whole picture.
Well, that brings us to the end of today's deep dive. We explored the wisdom of Peter Lynch, reminding us that these principles connect not only to investment decisions, but also offer broader life wisdom. We really hope digging into insider trading, from Bezos to the basics, has given you some practical tools. See you next time.
This was What Would Peter Lynch Do? Thank you for joining us today. Have a great day.